Welcome to This Explainer. Today, we're taking on a really fascinating challenge. We're going to run Take-Two Interactive, the massive gaming titan behind Grand Theft Auto and NBA 2K, through an absolute gauntlet of legendary investment frameworks. We're going to look at this company through the distinct lenses of Warren Buffett, Peter Lynch, Benjamin Graham, and even some modern discounted cash flow models, all to try and find its true intrinsic value.
All right, let's just quickly run through our roadmap. We'll start with Section 1, the Take-Two snapshot. Then we've got Section 2, the Warren Buffett lens, followed by Section 3, the Peter Lynch lens, and Section 4, the Benjamin Graham lens. Next up is Section 5, DCF and alternate valuations, and we'll wrap it all up in Section 6 with the final guru synthesis.
So, let's jump right into Section 1, the Take-Two snapshot.
$6.72 billion. Let that number sink in for a second. That staggering figure represents Take-Two's record net bookings for fiscal 2026. They literally blew past their initial guidance by a massive $750 million. The sheer scale of this company's reach, driven by their powerhouse core franchises and huge mobile acquisitions like Zynga, is undeniably massive.
But when we peek under the hood at their core vitals, we see this really fascinating contradiction. I mean, they have a sprawling $43 billion market cap, and they generated an impressive $450 million in free cash flow. Yet, if you look at the bottom line, they're currently reporting a net loss of $298.2 million for the year. This dynamic, massive cash generation living right alongside reported accounting losses, makes valuing this company a highly complex puzzle.
Moving on to Section 2, the Warren Buffett lens.
So, how does Take-Two stack up against the Oracle of Omaha's checklist? Well, economic moat? Pass. The intellectual property here, especially Grand Theft Auto, is an absolute fortress. Debt levels are also well within a manageable range. However, Take-Two hits a major wall when it comes to earnings consistency. The video game industry is notoriously hit-driven, which makes their earnings incredibly lumpy. And because of that reported net loss we just talked about, return on equity sits at a negative 8.51%. For Buffett, who strictly demands a high and consistent ROE, that is a glaring red flag. Now, what about the people running the show? Take-Two is led by Strauss Zelnick and his team. If we look at their historical performance, Zelnick's compensation is heavily tied to performance metrics like adjusted EBITDA. Over a 5-year timeline, you can clearly see how their strategy has generally aligned with long-term shareholder value, pretty much pacing with major indices, even with some recent cyclical dips. And Buffett absolutely loves aligned, honest management.
But does Take-Two actually pass the ultimate Buffett test? Well, because net income is currently negative, calculating a traditional owner earnings margin of safety is effectively impossible right now. Buffett requires predictability to calculate a target buy price. Without it, he would almost certainly stay firmly on the sidelines at the current $231 price tag.
Let's pivot to Section 3, the Peter Lynch lens.
Peter Lynch would probably look at Take-Two and categorize it as this really interesting, cyclical fast-grower hybrid. It's a company whose revenue operates on massive but infrequent product supercycles. The big narrative right now is that fiscal 2027 is poised to be an absolute breakout year, with projected operating cash flows exceeding $1 billion. And that is entirely driven by the highly anticipated launch of GTA 6.
Now, the absolute crucial point for Peter Lynch is this figure right here, 0.77. That is Take-Two's PEG ratio, which is price to earnings divided by growth. Lynch famously states that a PEG ratio under 1.0 is the holy grail of investing, because it signals that a company's immense growth potential is actually underpriced by the market. Take-Two absolutely nails this metric.
Actually, a quick side note on our assumptions here. Lynch also loves to see heavy insider buying and stock buybacks. Because our sources don't detail the current insider buying data, we have to explicitly state our assumption that we're relying heavily on the growth narrative. Buyback spend is currently sitting at $0. But even so, leaning almost entirely on that stellar 0.77 PEG ratio and the massive upcoming product cycle, Peter Lynch's framework would likely rate Take-Two as a very compelling buy.
All right, on to Section 4, the Benjamin Graham lens.
Benjamin Graham is famously ruthless. He uses a strict, backward-looking defensive checklist. Adequate size? Out of $43 billion market cap? Yeah, it passes easily. Strong financial condition? With the current ratio of 1.24, meaning they've got more short-term assets than liabilities, they pass again. But look at the bottom 3. Earning stability? Fail, due to negative earnings per share. Dividend record? Fail, they literally pay 0 dividends.
And finally, Graham demands a moderate price-to-book ratio of no more than 1.5x. Take-Two sits at a massive 12.3x, so Graham's checklist basically halts Take-Two dead in its tracks. And here is the ultimate quantitative punchline of Graham's framework. His famous intrinsic value formula multiplies 22.5 by earnings per share and book value per share, and then you take the square root of that. But because Take-Two's EPS is negative 1.62, the math literally breaks. You simply cannot find the square root of a negative number. Benjamin Graham wouldn't touch this stock at any price today, no way.
Next up is Section 5, DCF and Alternate Valuations.
To bridge the gap between today's losses and tomorrow's GTA 6 cash windfall, we have to run a discounted cash flow model. Because our sources don't provide a specific weighted average cost of capital, we're assuming a standard 9% discount rate. We're also projecting aggressive 15% free cash flow growth heading straight into that fiscal 2027 GTA 6 launch with a 2.5% terminal growth rate. As you'll see in our base case, right in the center, this yields a fair value of $150 per share. With the stock currently trading way up around $231, the DCF model suggests the company is significantly overvalued right now, at least based purely on projected cash flows.
And we can actually verify this premium by looking at some alternate models. Comparing multiples, Take-Two trades at an enterprise value to EBITDA ratio of 37.4 times. That is a massive premium. But look at their profitability. Take-Two currently possesses an EBITDA margin of just 17.8%. Compare that to tech peers like Apple at around 35%, or Nvidia at a staggering 76%. This high multiple combined with lower relative margins strongly indicates that the market has already fully priced in the success of the GTA 6 narrative.
Finally, let's wrap this up with Section 6, the final guru synthesis. So, how on earth do we blend these totally different philosophical approaches into one single conclusion? Well, Warren Buffett avoids it due to the lack of consistent earnings. Benjamin Graham issues a hard sell because it completely fails his defensive value mechanics. Modern DCF and multiples say hold because the price is already stretched far beyond base fair value estimates. Only Peter Lynch issues a buy rating, totally enamored by that 0.77 PEG ratio, capturing explosive future growth. Blending all of these together, the final verdict is a definitive hold. The absolutely crucial risk here is execution. Any delay or stumble whatsoever with the GTA V launch could be incredibly punishing at this valuation.
Ultimately, analyzing Take-Two Interactive forces every single investor to ask themselves a fundamental question. Do you demand the strict mathematical safety of the present, or are you willing to pay a premium today for the billion-dollar cash flow promises of tomorrow? It is a phenomenal case study in modern valuation. I really hope this structured walkthrough has clarified the risks and rewards for you. Thanks for joining me on this explainer.